Good evening. John Person here. Tonight's presentation, we're going to talk about technical tools, some things that I created and based off some work I did about 20 years ago. First, take a moment to read this important disclosure, and then I'll give you a little bit of background on myself and what we do. Person's Planet, I'm the founder of Person's Planet. It's a financial research advisory service company. I provide modernized trading strategies. I call it modernized because we didn't invent a lot of things like candlesticks. We didn't invent pivot points. I didn't invent volume or relative strength, but we certainly modernized some of these tools, and a lot of them can be found on multiple trading platforms. We have proprietary indicators, and bottom line, we have an advisory service, a weekly newsletter, a trading room, an algo room, and of course, I'm an active fund manager with J. Person Asset Management. So a lot of the things that you will see in tonight's presentation, or at least some of the tools that we use, were written in books, literally, which I believe the second edition of my second book is coming out sometime October. It only took me 3 years to update it, but we've been a little busy. The Candlestick Pivot Point Trading Triggers, that book came out in 2005, and it really revolutionized how people looked at candlesticks. We did back test studies, was the first guy that ever did a back test study on certain candle patterns. That book was amazing for a lot of people, introduced them to a couple proprietary patterns we called the high and the low close doji, really popularized what Person's pivots or pivot point analysis was, and various trading strategies. A lot that you find that was written in that book, I will share with you that has gone into developing both our trading model for J. Person Asset Management in our managed fund, as well as our algo strategies. The book on the left, Mastering the Stock Market, I can't believe that book came out in 2012. I mean, I just feel like I just finished writing that book, but it's amazing what's in that book from regards to seasonality, volume techniques, and the like. Last year in 2019, this is an old slide just to kind of show you where we've come from and where we've been. Last year was a pretty good year for us. This year is not bad either. This is our actual performance summary sheet. If you look down here at the bottom, you see the options, negative 551. It's because we used options as they should be used as hedges. So some of the big losses that you see, down 75%, 200%, 352%, those were hedges against long stock positions, like, for example, in GDXJ. So we've incorporated a lot of different option strategies around our stock portfolios, as well as back in February, if you look here with the green arrow, some of our indicators pointed out that we were getting quite bearish, and I want to share that with you tonight because you can get a hold of some of these indicators on a lot of different platforms, such as TD Ameritrade's Thinkorswim, soon to be merged with Charles Schwab. So back on February, we were looking at, on February 21st, we made the big bold call to get directly short the market. We had a big bearish divergence in the advanced decline breadth analysis, and so far this year, it's been just another great year for us. This is my managed fund, which is mostly consists of people's retirement funds, 401ks, etc. And as you can see, since we launched this fund, the market's been extremely volatile. This is as of the end of June 30th. We're up about an extra 4% from this level. I apologize for not having that updated slide, but our fund does this on a quarterly basis. So we've outperformed with a very smooth, very low drawdown, hardly non-existent drawdown relative to the overall market. So when the market crashed, we were in SDS, an inverse S&P ETF. So just to let you know, a lot of the things that we put out both in our advisory service, our newsletter, as well as what I do for myself in our managed fund, all comes from the material that were in those two books. I've been in front of the public eye for a number of decades. I've spoken at a lot of the conferences, both internationally here and domestic in the money shows. And, you know, with COVID-19, we've kind of stopped traveling. And to be truthful, I really don't mind not going anywhere because I've been everywhere. And I mean, when I've been everywhere, I mean, I've been from Czech Republic teaching traders to even Egypt, for God's sake. So I was going to say a different term, but I won't say that. But Sharm el-Sheikh was an interesting trip. Another one of my legacies of speaking for the International Federation of Technical Analysis Society. It was really a great event. The heads of the five family, as I call it, a Godfather reference. John Murphy, myself, Larry McMillan, a bunch of guys were all on the same plane, and we thought, boy, if this plane goes down, it's going to be interesting. When we landed, we were picked up by a military escort, and I went, you know, if I'm got to be military, have a military escort. I mean, the next time I want to see a pyramid, to be honest with you, I'll go to Las Vegas and see the Luxor Hotel. But anyway, I've been very blessed in my life, and I've taught a lot of this. I had great mentors when I first started in the business 40 years ago. My first boss name was George Lane, and George invented or developed an indicator called stochastics. And I worked for George for a couple of years, and then I went on, as many people may have known, my career path took me to trading options at the Chicago Board of Trade, and I just had a knack for the finances, and I just killed the market back in 1985 through 86 in the bond options. So that was my legacy. A lot of the techniques that I use today, I even picked up back then, and this is how we came about using Person's pivots. But to be honest with you, I picked up a lot of different things and improved upon things that I saw would have better relevance for me. And for example, we have an indicator on Thinkorswim and other platforms called the PPS. It gives buy and sell triggers. And we use that to help us scan for value or price changes in the marketplace, candle patterns, high and low closed dojis, as I earlier mentioned, Person's pivots. I do look at chart patterns. It's been a part of my teachings for the last 40 years. And seasonal and cycle analysis. George taught me a lot about seasonal analysis back in 1982. And that's one of the things that, I guess, from a trader in Chicago, you better know everything there is about the markets. And seasonal analysis was the first thing you learned. And whether or not you knew what a soybean or a corn kernel was, you knew that the harvest lows generally in late October, early November meant a buying opportunity. So certain things, whether it was in the bond market, the financial cycle, the sell in May, go away mantra, which was first established by Yale Hirsch. Now his son, my friend Jeff, manages the organization of the Stock Traders Almanac. And all of this seasonality really does have an important role in how we trade. This year, a lot of seasonalities were shifted because of the COVID-19 pandemic and the way the market's traded. But the irony is that, you know, markets generally have a tendency to sell off in the equity markets in late February, right after President's Day holiday. There's a general seasonal decline in the marketplace. And this year, of course, it was a little bit more accelerated than any of us anticipated. Right now, as we enter into September, there's a lot of different seasonal changes that take place, especially in the precious metals arena, gold miners, and material sector, and even biotech and healthcare, and we'll get to that in just a minute. I'm very proud of an indicator I created called the Person Volume indicator. It's a proprietary indicator, and instead of taking, I'll tell you what it's based on. Instead of taking actual real volume, it takes percent change of volume, and it converts it into like a momentum indicator. So it's a momentum indicator based on volume, but in terms of percent change. It's a little sophisticated, but it does a wonderful job of helping us to uncover whether or not there is true volume strength or divergences or volume weaknesses in marketplaces. There's other things such as relative strength, which we created an indicator called the PMC. It's a phenomenal indicator used widely by institutional traders as well as individuals that have access to this tool on Thinkorswim. And there's a few other things that we look at, and money management is obviously one of the key important elements of trading, not just making sure that you have a profit target, but also a trailing stop or some kind of a risk mechanism, but also position sizing guidelines. And there's an old phrase, whenever you're right, you're always in 1. Whenever you're wrong, you're always in 100. So having position size guidelines is very critical. And with that, I would like to introduce you. First, we'll talk about some of the indicators that you see on this page and what this all means. This is a strategy that we created using my PPS indicator. These little arrows are automatically painted on the picture. which shows momentum changes. An arrow pointing up signifies that the market's in a bullish mode. I don't know if you guys can see that little arrow right there, for example. A sell signal right there indicates the market can go down. This is an automatic trading system, and this shows you where a position was entered on a long. The blue line shows you where it was exited. This is a SPDR S&P ETF long position trade strategy. I will show you the update in just a minute. It's pretty crazy. We've really nailed it with this particular strategy. This is part of what we use for our analysis and our trade decisions for J-Person Asset Management in our managed funds. This tool down here, it's hard to see, but it's called On Balance Volume. I really didn't modify On Balance Volume. I just added a moving average approach to it to help smooth out these little fluctuations here. Basically, On Balance Volume helps to determine the trend of volume, but it's not as effective as this volume tool that I created that I was just referencing. And this is my volume indicator right here. And this kind of helps show us whether the true momentum of the market is going up or down. If the price is going up and the momentum's going down, that's a divergence. And it shows that there's kind of a net change coming, which if you look at this, and if you know when this date was, February 9th, it was already showing that the rally going into the end of February was losing positive volume structure. So that was one of the ideas. If you looked at the on balance volume, and if you study technical tools, there is good value in using the OBV, on balance volume indicator. However, it was giving a different picture. And it was showing that there was stronger accumulation of volume in the market, giving a lot of traders false hope that the market was going to go up forever. Instead, we all know what happened. The market went down. This is a page that comes directly out of one of our trading rooms. We have one trading room, but it has two windows. One's for stock traders, and one is an algo trade room. And there's a few things here that I want to talk to you about that we utilize to help us with trades. The first thing that I want to mention is what is the most important element for me to make a good trade decision is to know what the condition of the market is. And because I came to that conclusion about 20 years ago, that knowing the condition of the market, if I'm trading the S&P 500, I would like to know everything there is to know about the S&P 500. Futures trade off of the cash or the ETF. The ETF trades off the cash. Cash is derived by 500 stocks and their values. So what's really important for me and what we came to the conclusion to build was using TradeStation. We broke down the advanced decline instead of the breadth analysis that's available. We modernized it, and what we simply did was be able to create an advanced decline on the S&P 500. And this tool here shows that the advances in the S&P 500 on that given day was positive 555. So in the S&P 500, 455 stocks were positive, 40 were negative. If you have a positive, and that's what we call extremely positive breadth day, if the advancers outpace the decliners and you got a buy signal in the market, you're more apt to be on the right side of the trend of the market. So this is an equity curve of a 5-minute model. I mean, for God's sakes, 5 minutes, you can get in and out like there's no tomorrow. We have, if I may be so bold to share with you, this is one of the pages that we have for automatic trading systems. This is, I mean, you can get higher risk with 60-minute, lower risk with even a 2-minute, and you can trade. And this is a particular model, as you can see, a lot of the trades, even this is of today, a lot of the trades, if it's a blue line, it's a winner. So if it shows the entry, it shows the exit, it gets back in, it shows the exit. You can see all those trades. It got short, it got knocked out on the stop because the market upticked before it crashed, still took a profit, short profit. There's a couple losers in here, nonetheless. Here's a couple over here at like 5:30 in the morning. This is a model we like to utilize as far as when the average true range was at a historic high. And we had and if you're not familiar with average true range, it's another very important market metric to know. It gives you the overall condition of what the range of the market is. So this is what I have on this screen. This is a 60-minute model with our strategies. And you'll see right here, this is the average true range. Average true range, you can get an identification that the last, and this is a 10 period, it says 10 over here. This tells us that in the given last 10 periods, the ATR is about 9 points. The average bar of an hour is about 10 points. Why is that important? Well, first and foremost, if I get a buy signal, and I know if I have a stop in the market, I might have to have a 1 or 2 deviation or 2 standard deviation of risk. What is the risk based on, if it is based on ATR? I know I have a 20 handle risk on a 60-minute basis. Gee, I got 20 handle risk. I don't think I want to do a 10 lot right now. I can reduce my lot size based on the volatility or increase my lot size on reduced volatility. So there's a couple little things that we'd like to teach traders with. It might be a little bit advanced, but these are the metrics that we all have, believe it or not, equal access to. All of this is based off of 4 common denominators: the open, the high, the low, the close. But it's the relationship between those that helps us build trading strategies and winning strategies at that. Over the summer, we created this particular model here on swing trading for the Spider, the Qs. One of our active trade programs that we use in part of also J-Person Asset Management is the VXX, the Volatility Exchange Traded Note, VXX. We created a model for IWM, and we created one which I feel is going to be important as we get through the next 2 years, if not 4 years, of the next presidential cycle: biotech, drugs, and looking for the vaccine and the cure for COVID-19. But the fact is, we still have a lot of work to do with multiple sclerosis. We still have a lot of work to do with cancers. And so biotech, I believe, in this environment is still going to be a very valid and tradable, keyword, tradable market event. So when we take a look at our models here and just look at performance and equity curves, they're green, they're smooth, they're pretty decent. The Qs are off the chart. This is the equity curve. On the Qs, it made just another new equity high again today. This is the VXX. It got a little choppy. And this, by the way, I'll bring that into speed for you, or focus, so you can look at this. This volatility is unreal right now because of the fact that there's such a disconnect between the stock market going up and volatility rising as well. Usually it's an inverse relationship. I'll cover that in just a second for you. The Russell, here's another model that we had, which, by the way, as well made a new equity high. It's got just a slight pullback in here, but it's net short. It just went short today on the Russell. So the Russell went short, and you all know what's going to happen right now. The market's down a little bit in the after hours. This is the biotech ETF, the XBI, and it went long. It's in an active long position, and you can see it's in an active long position it says it's long. It bought. There's your arrow. There's your entry. And here is the initial profit target. There's the initial loss, and we can cover that in just a minute. What I wanted to just touch upon is that if you can build models in different markets that are either correlated, more importantly, in this case, non-correlated. And generally speaking, the Russell and the S&P, they're both stock indexes, but this year they're not correlated at all. And when you have an individual sector ETF like biotech, which has not really performed well in the year, and you can take a look at developing backtest studies and developing trading strategies that have good performance. These are things that help you to identify better trades. And so I guess I could have summed this up really quickly and said, I'm just a rule-based trader, and that's what it is. I created different scans, and some of the scans that we created, such are what I call what I wrote about 20 years ago, which helped popularize dojis. I was the one out there in a lot of different conferences and things. And my book called Candlestick and Pivot Points highlighted this pattern called the low and the high close doji. It's a very unique pattern, which, as you can see, we highlight with these little pink magenta colors. By the way, Jeffries, which is this scan I just ran before we began today, this Jeffries and Company is a financial asset broker dealer. Jeffries has generated a daily sell signal, by the way, for going into tomorrow. This is actually today's results running that particular scan. So this is as of August 31st. You can see when I ran the scan last at 4:45 in the afternoon. Looking at and we go over here to format just to share with you so that you can see everything. So it's clear. I ran a scan in the NASDAQ, the New York Stock Exchange, and the S&P 500. So that's my symbol universe that we're looking for sampling of data to find out what sectors were generating sell signals at the end of the day and what sectors were generating buy signals. The irony is that look at the amount of financials, some energy in here, and you'll see Williams and Company, you'll see Murphy Oil, for example, consumer cyclicals. Now, first and foremost, this is a TradeStation program. They do a phenomenal job for what they do, but just to be a disclosure, and I hope from TradeStation don't get mad at me, but they could do a better job in classifying what sector and industry groups are. I don't find Movado, a watch apparel company, to be a consumer cyclical stock, but that's just me. Hasbro's a toy manufacturer. Hanes brand is clothing. Natuzzi is furniture. So you get my point. It makes it hard to get down to the sector groups of what we're looking for. Why am I doing this much work? I'm really not. I'm like letting computers do the work. But in this day and age, when people are so confused as to what's going on with the market and how much sector rotation, and it seems that everyone's just piling into like those 10 names, your Facebooks, your Tesla, Zoom, which had great earnings or a good earnings report and a great reaction after earnings tonight. What we like to do is to define what segments of the market we're starting to see institutions go into, and that's where these scans help us. And then therefore, instead of chasing markets, we're in from the ground floor, and we're also looking for stocks that might be running out of steam. Now, when I say run out of steam, that's there's a way to look at certain things in the marketplace about running out of steam. And for that, I'd like to, you can clearly see this little thing called J-Person Market Catcher. That's called the PMC indicator. And I don't know if there's a lot of folks here from Thinkorswim, but this is my Thinkorswim account. And we have Person's Pivots. And we also have, since I don't have my volume indicator on Thinkorswim, we use on-balance volume in lieu of that. But also I like to take a look at something called the Person's Market Catcher, the relative strength indicator. If you go over here to studies and you go to add a study and go to my name, John Person, I only have 3: PMC, PPS, which is the buy and the sell arrows, and Person's Pivots. So I'm going to turn on PMC, and this is the VXX. So that's probably not going to be a worthy adversary for that indicator. Again, what I wanted to share with you, whether you're trading equities or whether you're trading day trading for stocks or day trading in general, different tools are for different jobs. A day trader is just a momentum trader looking to what we consider to be a scalp. Maybe a holding period is maybe 55 minutes up to an hour and a half for a directional trend, versus an investment or a swing trade, especially in an equity, a stock. We want to use specific tools. The PMC is a relative strength tool. And let's go and just take a look at TSLA right now, Tesla. Just type it in Tesla. And we're going to change this over to a daily chart just for the heck of it. So what does the PMC indicator do? It's a relative strength tool that gives you the comparative ratio strength or weakness to the S&P 500. And there's 4 stages that we see a market in. Bright blue means that the stock is starting to outperform relative to the S&P. Dark blue means it's starting to weaken, and if it goes red, it means it's lagging the S&P. What we're looking for are buy signals when a stock is starting to see relative strength improvement. When we get a stock that is starting to rise and the relative strength is weakening, it shows that the market is getting ready to reverse. So we could take a look at a few names, and it's kind of tough to find weakness in this market except for in several 3 sectors: energy, real estate investment trusts, and utilities. Those are the 3 segments of the markets that are the weakest. So as you can see, when I say the weakest, if you're looking to buy a utility sector stock, the momentum, this is not a price-based momentum, this is a percent change value. And when the relative strength is negative, moving lower as the stock, if this thing's moving up and relative strength is going down or below the 0 line, baby, you don't want to be long this stock, and you don't want to be buying a pullback. This is a sector and a stock to avoid. So again, relative strength is a phenomenal tool. Here you can clearly see even this year on a weekly basis with the utility sector. Here's a market that's running up, and the relative strength, it's just ugly. There's nothing there. Why would anyone want to be in this? And again, this was this year on a weekly basis, the big kahuna crash, as we like to call it. So we have several indicators on Thinkorswim: the PMC, the person's pivots, and the PPS, we call it, the buy and the sell arrows. And the nice thing about that is you can, in Thinkorswim, run their scanning functions with our indicators. Just go to license studies, go to buy. For example, you want to find out how many stocks generated new, fresh, a monthly buy signal today. Just hit this, and you can see, ironically, look at this, biotech. A lot of big names. Well, we're in the biotech sector, so let's try this again. Let's go to just run Russell 3000. So that should be a listing of about the best 3,000 stocks in the market. So we're going to run a scan to find out what stocks generated new, fresh, monthly buy signals. And this is how you can start to look for opportunities in the market, not only by looking at an individual stock, but also the concentration in the sector, which, as you can see, Thinkorswim does a really good job of breaking down the sector industry. So you have a lot of names over here. We know Mosaic, Ab Marley in the materials sector, and we can go on down the line, and hotels, internet. There were a lot of new, fresh monthly buy signals. American Eagle Outfitters, Gap, for example. So retail apparel, that's Lands' End, LE over here. Expedia.com. There were a lot of different names that generated new, fresh monthly buy signals. And then again, in the biotech, you got a few names there in the biotech space, in the pharmaceutical sector, Jazz Pharmaceuticals, for example. So I would do a little bit and say, wow, that's kind of interesting. And yet, if we take a look at the IBB, as I just shared with you, what I like about that is, at least with our models, is that we have long exposure to the biotech. So we might see at least some kind of follow through upside this month in September in the biotech sector. So that's one of the things that I would have to say, if you're looking to identify where the money flow is going, these are the kind of tools that we use to help identify that and get, I would say, a better edge in the market and get ahead of the crowd rather than trade off of what was in the news. And that's one of the important things that I think most investors should learn, not really to try to be your own analyst, but your own guru, but to be able to validate and verify for yourself what the conditions of the market. Anyone could just open up a trading account and start whizzing away at trading. You want to be proficient and you want to be successful at it. There's a wonderful product that we also joined up with and put our indicators on, and it's called HGSI software. And these guys put on, for stock trading, I'm here to tell you, the most amazing bells and whistles that I've ever seen for a market. It breaks down the industry, the sector. It puts everything, whether the PBS, my signals, the relative strength. We can look at adding, filtering groups and industry groups for daily stocks that are in daily and weekly sell signals, and then identify what the condition, whether they're improving with relative strength or whether things are disimproving. And we can also, besides looking for sell signals, we can also identify buy signals. And we identify if anything's in a weekly, fresh, new buy signal. The indicator that I talked about, the PMC, the relative strength, when you get a buy signal in the market, I want to look for a price that's generating a positive activity, an action that's positive, right? What attracts buyers to a market? It was higher than it was 2 weeks ago, or it's super duper cheap and someone's got inside information knowing that it's going to be super expensive later. What dictates price is that there's a buyer and there's a seller, and if price is going to go up, someone's willing to pay for it higher down the road. I mean, that's it. If I'm looking at a buy signal, I want to know, is it going to be able to capture the attention of others? And the last stock that I want to look at buying is a stock that's lagging behind the actual performance of the S&P 500. Improving, yes, but lagging, no. The odds are, I don't even know who this guy is, Cyrusone. Let's take a look at it real quick. The relative strength is weakening. The stock's not going anywhere. This is a daily chart. This is the weekly chart. This is a real estate investment trust. It's 21 times forward earnings. Its price to earning ratio is 21.42, and it has a dividend yield of 2.4%. That might be okay for someone that doesn't have anything better to do, but the fact is that the price action relative to the overall market has weakened. And it's something that, this is not one that I'm a big fan of looking at, specifically in the REIT sector right now. What I would be focusing and what I would like to focus in on, and we can go right over here and change it up to sector now that I've been seeing there's a lot of scans in healthcare and biotech, is to find out what opportunities are in the market in the biotech sector. So here's the name of a company, Agenus. It doesn't have a PE. It's just basically a penny stock. It's a sub $5 stock, but it has been, in terms of percent change, outperforming the market, and it is going up. So maybe this could be a little short-term, little doohickey to the upside. I would look for something a little bit better for myself. Alexion Pharmaceuticals, I didn't click on the right one. Let's get to Alexion. We all know that one. We all know, and this is a stock that the relative strength's getting less bad, but it needs to get better. And you can see that when you get a buy signal and the momentum of the relative strengths improving, you have a better chance that there's going to be momentum or follow-through strength in the market. That's how I look for selecting good or better valued stock plays in the market. And all of this that I've just gone through with you, the relative strength tool, the PMC, that was information that was covered in my book called Mastering the Stock Market that was written in 2012. And all of these other programs were based on the works that I wrote from that book called Candlestick and Pivot Point Trading Triggers. So I wanted to just say that in this environment, you have to be very nimble. It's damn near impossible to trade the market successfully over time being emotional. You cannot bet with your heart. You cannot trade with your heart. You have to trade with a cool, calm, collected strategy, and your emotions need to be in check. There's no doubt about it. Trade systems, they're going to fail, especially if they're trend following models when the markets go flat and they don't move. They're going to take breakouts. A lot of different trading strategies and systems were breakout models. Mean reversal, what does that mean? Market goes up, it's too far from a moving average. Someone wants to sell short. You know, you can have made money last week selling S&P short a couple times during the week when they were near their highs, but when the market broke down, it made it very hard to make money because the market zinged right back up in your face. So again, mean reversal programs go south when the market move is in a parabolic trend mode. And guess what? That's what the market is. By the way, I didn't just create this slide for this event. This slide's about 10 years old, gang. 10 years old. This slide is 10 years old. I cheated because I didn't really need to change my tune. I don't have a new indicator. I don't do something new every week. This is what I have. This is what I've built my career on. And this is the thing that I think that most trend follower or any type of trade system program trader has a strategy, a system, and they should know that no system works all the time. And you have to know what your available your risk is per on its history. Most systems do not account for changes in volatility because most trading systems are based on a moving average component. And when I say that most systems do not account for changes in volatility, I'm referring to average true range. This year, and I want to go back to this page right here, and I'm going to go over to this model right there. I'm going to do something I don't like to do, but I'm going to change this to a daily chart just to show you something that's amazing. Let me change this just to the continuous contract in ES. So how was this year in trading? Let me tell you, it was historic. It was record breaking. It was monumental. The irony is, if you guys were around long enough, if you're a new trader, you might, and you just walked into this business in the last 2 weeks. The funny thing is, over the last 2 weeks, look at the 10-day. This is a daily chart, and I'm using 10-day ATR. It's one of my top indicators, one I've been using for 30 years. The 10-day ATR is around 33.42. Now, what you don't know is about what I'm going to tell you, so listen. I'll actually write it down. The 5-year historic average for daily range in the S&P 500 is about 28 points. 28 S&P points. That's about the 5-year average. It's 28.73. I rounded down. We're still elevated even with today's action at 33. Do you guys remember in December of 2018 when the market crashed and everyone was freaking out because the ATR went to approximately 86 points? That was unreal, 86 points. But this year, we went to 248. All right, so that means that we had a 210-day average of volatility. The bars averaged out a range in the S&P of 248 points in a day. So this year, both, as you can see, ATR, if you were using a moving average, you could not have helped to figure out your risk factor on a strategy of a moving average component. By the time the market has returned back to near its 5-year norm of trading volatility or daily trading ranges, you're out of money, right? So it makes it hard to survive unless you have a strategy or a system that helps to determine the risk factor based on volatility as defined by this metric here called average true range. This is a gift from a technician called Wells Wilder. It's some of his best work, least discussed. Most people don't use it. They use his other indicator, which is an overbought, oversold indicator. Some of you are familiar with it, called RSI, a price-based relative strength indicator, not a relative strength comparative ratio like we have with our stock PMC indicator. Big difference. Know the tools that you have at your disposal and know what those tools' job is to do. ATR also helps you to determine the market condition, and you can figure out what the potential range might be. ATR, and this is a very important point, one which I expressly share with a lot of our members, but I will give it to you tonight. It's as you have probably surmised through history on average, because every year is different, markets go down a lot faster and further than they go to time to go back up. So they say the markets take escalators down and stairways up. As a result, one of the clues that you might be coming near a period of correction is when markets rally and the ATR, or the volatility, increases. When volatility starts to increase, your ATR will start to subtly move higher. If you look over here, we started to see higher highs and higher lows, higher highs and higher lows before we got into the big crash. You can clearly see it. You can back test it yourself. You can study it to your green. I'm trying to tell you that ATR is not normally a function of trend or price direction. It's an indicator of market condition, with this one exception. This is what's important. When it comes to the stock market, ATR can share with you that there's a shift or a potential trend reversal, because ATRs expand higher in falling markets. So generally speaking, when the ATR is starting to get elevated, you start to see that associated with declining in the equity markets only. The VIX, you guys are familiar, if you're familiar with the volatility index, the VIX is a measurement of demand for puts and calls against the S&P 500. Now, why would someone want to all of a sudden buy puts and then the measurement of the VIX would go up? Because they feel something's happening, or there's a change in volatility as measured by ATR. There's the connection. There's the lesson. One of the tools that we use to help us to determine A, position size, B, again, market condition. So a lot of times you will find that to be not only on my own charts, our pages, in our development of strategies. That's one of the models that, or technical tools that we use. Now, if I may be so bold, I'm going to share this with you right now about the NASDAQ 100, because we just did something very unique to the market in the Qs, and this is an open position long. It does have an emergency stop right here. So this is the initial risk. That was the long entry. That was the profit target. If it doesn't hit, it's got an emergency stop. If the market gaps lower tomorrow, this thing will be out on the open. If it opens below that orange line, this thing's going to be out, hook or crook, doesn't matter. One thing that we definitely see is a function of a change of momentum of volume. On balance volume kind of shows that this rally looks healthy by making consecutive series of higher highs. Our momentum volume is showing that this thing's getting a little tired up here. Now, I would be, without sharing too much more information, I would like to show you, this is the Algo 17. This is a program we built on TradeStation. So this is something that helps investors do a couple things: build their own strategy and backtest it. Gives you the idea of when should you start. If you're trading an ETF, let's say you're trading foreign currencies or you're trading futures and you wanted to trade the open and just the close, or the first hour or the last hour, I can program start time 9:30 and then I can end 11 a.m. And then if I want, I could program start time to restart again trading at 2 p.m., which is 1400 military time, and then end at 1600 if I wanted to. I can also run and do something which is interesting. I can optimize to say, well, what is the best time to trade? So it'll tell me what the best time to trade is within those parameters. We also built in this thing called position sizing guidelines. We have 3 different position sizes. 1, equity amount. If you're trading 20,000, you can put 20,000. If you're trading $1 million, you can put $1 million. Position risk. I only want to risk $2,000 per trade. If I'm trading in equity on a $100,000 account, I'm risking 2% of my portfolio on that trade, or 1%, whatever. You would punch in position risk 1,000, and then you would position calculate, change that to 2. If you're trading futures and you say, well, I only want to trade 2 contracts in this environment, then change that to 3. So you have position value by dollar amount, position value by risk amount, and position calculation by contract sizes. You could also just say 100 shares if you're trading stocks, or 300 shares, et cetera, et cetera. Maximize your trade loss, maximize your profit. Both of those functions can be optimized. Exit strategy, and this is something very unique. My last conditional change, a dynamic, a compression exit, customizable exits. And what's really interesting is, as I just shared with you in ATR, markets go up differently than markets go down. So therefore, we were able to optimize our buy signals. And in this case, with the Qs, we would take a PPS buy signal with a 2-to-1 risk-reward ratio initially, but it won't take a buy unless it's above a 7-period moving average based on the close. We also incorporated a moving average of high, low, and close. And I don't know if you hit optimize, should I use a moving average of a high, a moving average of a low, or moving average of a close? I don't know, but let the computer find out. 1 is high, 2 is low, 3 is close. So this actually gives me the ability to optimize and build a strategy saying, hey, I want to filter out, I want to take every buy signal. I want to take buy signals that are filtered around specific moving averages. If I'm taking a buy signal, I would say maybe a buy signal above a moving average of the highs. That would certainly be a breakout, right? That's a breakout strategy. So we've built into the coding using TradeStation's technology our ideas. We did on sells, we broke it down. Risk reward on a sell, optimized out at 2.25. Moving average of 12, and a moving average of a high. It has to sell. It has to trade below a moving average of a high. So that function 1 represents high. This is a holding period, max trading bars. What's the amount I should trade the bar? The least is 10, the most is 60. What's the average holding period for this trade or the market to give me a profit? And well, I'm not sure. Let the computer tell us. And so we can run an optimization function and do it that way. We also have another entry confirmation. This says enter trade at the market. We can enter a market order, or we can optimize it and say, should I go market order or should I go limit order? 0 and 1, true and false for trade market order. And I can hit and I can optimize that. And I can find the best results, whether I should be going at the market or whether I should be using a limit or a stop order. So this is kind of some sophisticated criteria that we built into TradeStation to help us not only build strategies, maintain strategies, but that's what helps us to generate good trades, as well as build performances that we can say, hey, is this thing make money? I mean, we built this strategy about a month ago, and since it's done extremely well in this environment. So the moral of the story is that there are a lot of tools out there that traders have, and there's a lot of indicators that individuals can use to help them build their own systems and verify signals. And that's one of the key things that is amazing about this environment in which we're trading right now. I mean, the days of old were simple compared with what's going on right now. I did want to share this last bit with you and to try to keep it more like current, so to speak. The market has this incredible divergence. This is a page that shows the top 5 stock indices we trade. The first is the Dow Jones Industrial Average. This is the NASDAQ 100. This is the NASDAQ Composite. This is the Russell 2000. And this is the S&P 500. So I'd just like to briefly share with you what the condition of the market is. First and foremost, we've been trading up against a person's pivot resistance. The relative strength versus the S&P has been negative. It can't even muster any strength. The volume is tepid, weak at best, and the advanced decline is divergent and just made a new recent. We didn't break the weekly low, but we are near a high in the market at resistance, and the advanced decline is nowhere near its high. That's a divergence that says that more stocks are selling off. Now, if the market is going to advance up, one of two things has to happen. One, we need a hell of a lot more volume to push the index and the major markets that affect the Russell, which is the regional banks and energy stocks, have to participate quickly, or the advanced decline of the average of 2,000 stocks better find some buyers, because this, my friends, is a divergence scenario with the Russell of the index itself. The S&P 500 is in another scenario of a divergence. We broke out and made a newer high. We went well beyond the person's pivot resistance, and the advanced decline, meaning of the stocks, it is in a negative divergence. This is another way of measuring the advanced decline. It's a McClellan oscillator, but we modified this, modernized it, and we use it based off the data in the S&P 500. As you can see, the higher the price action has been going with the equity market, the lower the reading is, and I'm sure you could see this right now. It's got a negative 10.08. So the McClellan oscillator is actually negative, and if it starts to continue to trickle down, baby, this market's got some downside action coming pretty quickly. We have a massive divergence in the market in price made newer highs, and the breadth of the market made lower highs. The volume is, I would have to say, about one of the stronger divergences we had than we did back over here. Now, I'm not saying that we've got that type of sell-off coming, different kind of circumstances, but I could definitely say that we're not a big fan of being long up here in the market at all in the SPY due to that. The other divergence that I wanted to bring to your attention that exists is in the volatility. I think I already shared that with you based on our ES model with the VXX. And if you notice, this is a volatility index. Again, this is a wildebeest of a trade. We've had a great time with this year, last year, and since we've been trading this since about the 2015. But here's a funny thing. As the stock market made new highs, the volatility of the VIX should be making a new low. That's a divergence, okay? More importantly is over the last week, there's been volume accumulation in the market, and even on-balance volume is showing that. So you have a divergence between the volatility of the market itself. So I would have to say that we have indicators and strategies that are got a good finger on the pulse of the market. We have great intermarket relationships that's occurring. And if you're interested to learn more about what we do, our program with the Algo 17, we call it the Extreme version 2. It's actually the 90th because we keep having updates and upgrades. But this is one that a lot of traders, and it's available through TradeStation. Like I say, it generates trades. It shows you where your entry is, your exits. For those that are interested on learning more about what we do, we conduct what's called, well, I guess the best way of saying is customer appreciation webinars. If you're interested, we do how to use our tools both for TradeStation. We call it the PUG, Person's User Group. We have monthly meetings for free where we just talk about the indicator and how to use it on these platforms, both Thinkorswim and TradeStation. The next event is September 16th. I generally conduct them at 4:30 right after the market closes. I'm an active trader. I'm managing a fund. This is a very rare occurrence for me to stay up on a Monday night at a 7 p.m. I feel like, boy, it's like I haven't done nightly webinars forever. But if you can't attend, we do record them, and we can send you an email of the recording. You could go visit our website at personsplanet.com, sign up there, free webinar. Where it says contact us, just say webinar. There's a place up on the top header. I mean, if you know how to read an email or a website, you could look at the top headers. That's what they're there. Contact me. Hey, put me down. I'd like to take a ride on your Thinkorswim or TradeStation client event. I'd like to wrap up and finally say that the markets are the most dynamic I've ever seen in my life. These markets have had, we've had a great year. We've had a great few years. I think the rest of this year is going to be nothing more than stunning in the fact of more records will be broken. We'll probably see my prognostication, if there was ever a chance, and I've never in my life been a big gold bull because I started in the business when gold was going down, not up. I've just seen gold never go up. But right now, since last year, I've been one of the biggest bulls on both, and that's one of our holdings with the junior miners, GDXJ. Owning silver, telling friends and everyone that I know to buy. I actually tweeted out to buy Liberty dollars. I never bought silver coins before. Just Liberty dollars, 2020. They were actually at a discount because no one wanted to buy the 2020 because they thought they were bad luck because of COVID-19. When silver was at 17 bucks a couple months ago, I was telling everyone buy these because there's not a numismatic premium in these because they can't unload them. No one wants to buy them. So they were giving some good value on above cost price on the Liberty dollars, by the way. I think that's all changed now because silver's like just shy of, or just north of 28 bucks. But in any event, I think we've got some really interesting times ahead. There's no doubt about it. The Fed, interest rates, the pressures, this is going to be exciting trading. And I think all you need to do is understand a few logical elements of the marketplace and be disciplined. And remember that. Don't trade with your heart, trade with your head. The key to success comes from not only the right education, but applying what you learned. It's consistency over a period of time that one acquires confidence. You're going to have a few losers. If they're manageable, you'll be thankful for a small loser. If you got stubborn and thought last week the market couldn't go any higher, you were blown up. You know what? If you took a short and you got stopped out, fine, get back on the gravy train when a better setup happens. And that's what makes people money. You are going to have losers. Got to understand how to get out of them. And you got to stick with the winners. Remember, losing trades will happen. And it's all right to lose your shirts in this market. Just don't lose your pants because that's where your wallet is. That's an old famous line of mine. It means you're going to have losers, but if you lose both your shirt and your pants, you have no money to get back into the business. So you got to be disciplined and be patient in this event. I wanted to say thank you to the organizers for allowing me to come in. It's been a while since I've done personal webinars and public appearances, so I'm kind of creeped up in my own little trading war room here. If you have more interest in what we do, go visit us at personsplanet.com. And as a shameful plug, the second edition of Candlestick and Pivot Point Trading Triggers will be out sometime in October. Thanks for letting me participate. Everyone, good luck and have a great rest of your year.